All right, so are you ready to unlock some serious investing wisdom? Because today we are diving deep, deep into Benjamin Graham's The Intelligent Investor.
A classic.
This book, published all the way back in 1949
Oh, wow, yeah.
and updated several times since then, it's practically legendary at this point. It's like the Bible of value investing.
It is. It's a classic for a reason. Graham's insights are just as relevant today as they were decades ago. Market psychology and long-term strategy, it's all in there.
And that's what we're going to be exploring. We've got some, I think, some fascinating excerpts lined up for you today.
I think so too.
We're going to be exploring how Graham defines an investor versus a speculator.
Big difference.
Yeah, his thoughts on those super tempting growth stocks, and even a quick look at some alternative investments that he considers.
I'm excited.
So by the end of this deep dive, you'll have, I think, a much clearer picture of Graham's core investment philosophy, whether you lean towards a more cautious approach or you're ready to take on a bit more risk.
What I really find fascinating about Graham is that he doesn't just, tell you what to do. He really digs into the why behind his recommendations, helping you develop a sound framework for making your own informed decisions.
That's what makes this book so valuable.
Yeah.
It's not a set of rules. It's a way of thinking about investing. And one of the first things he does is he establishes a very clear distinction between an investor and a speculator.
Mm-hmm.
He's pretty adamant about this.
Yeah, he is. He's very clear about it. Right from the start, he lays it out. An investment operation is one where you are aiming for both safety of principal and a reasonable return.
Mm-hmm.
But you got to do careful analysis first. Anything outside of that,
Yeah.
speculation.
And, it's interesting because in today's world, with all this day trading and quick profit schemes out there, the lines have become even more blurred. I think even more than in Graham's time.
Absolutely. And he actually even expresses frustration in the book that on Wall Street, everyone gets lumped together as an quote-unquote investor.
Yeah.
And it's like, the word has lost its meaning. It's meaningless now.
It's like calling someone who buys lottery tickets an investor.
Exactly.
Maybe they'll get lucky, but it's hardly a sound investment strategy.
Exactly.
Graham actually gives a pretty striking historical example to illustrate this point. He talks about ridiculously high stock prices in the past that, because they kept going up, were later deemed investments.
Hindsight bias, we see it all the time. Past successes rationalized, even if they were based on pure speculation, maybe even just plain luck.
It's like saying because you survived a jump without a parachute, it was a calculated risk.
Exactly.
But okay, let's shift gears a little bit and talk about the approach that Graham outlines for the more cautious investor, what he calls the defensive investor. This is someone who's looking for stability, safety, and not a ton of hands-on management.
Right, exactly. And what's interesting is that Graham doesn't shy away from recommending a good allocation to bonds for this type of investor. He suggests anywhere between 25% to 75% of the portfolio should be in bonds.
That's a pretty big chunk, especially when you consider the advice you hear today, which tends to be a lot more heavily weighted toward stocks.
Yeah, and that's why you got to understand Graham's reasoning here, because he doesn't just throw these numbers out arbitrarily.
Yeah.
He emphasizes adjusting this ratio based on what's happening in the market. Like, in a bear market, when prices are lower, increase your stock allocation. And when the market's booming, you'd lean more towards bonds.
So it's not just a stack allocation, but a dynamic strategy that responds to the market, which is ever-changing.
Right. He even gives some historical context to illustrate this. Back in 1965, he observed that bond yields were actually higher than stock dividends. This was a sign to him that people needed to be cautious in the stock market. But just a few years later, in 1971, the situation flipped completely. Bond yields went up even higher, making them even more appealing compared to the Dow Jones.
That's a big difference. It highlights a really crucial point. Market conditions matter a lot. What might have been a sound strategy in one market environment could be totally different in another one.
Absolutely.
And this leads us to a question I think a lot of investors grapple with, especially in recent years. How do you navigate the ever-present threat of inflation?
Big one.
It's a concern that's top of mind for so many people right now. How do you protect your investments from being eroded by rising prices?
Well, this is where things get interesting, because you might assume that stocks would be a straightforward hedge against inflation, but Graham isn't so sure.
Really?
Yeah, he acknowledges that some investors believe that common stocks are the answer, that they'll automatically go up as the cost of living rises. But he challenges this assumption.
So he's not saying stocks are bad during inflationary periods.
No, but he's warning against blindly assuming they're a guaranteed inflation hedge. He looks at the data and points out that if inflation were to rise consistently for a long period, it could significantly impact even relatively safe investments. And when he looks at the historical performance of the Dow Jones, the returns, while positive, aren't necessarily the runaway gains that some might expect during times of inflation.
So you might see your portfolio increase in value, but your purchasing power could actually be shrinking.
Exactly. And there's a crucial point he makes that I think gets overlooked sometimes. He says that for inflation to truly add to a company's value, it needs to boost the rate of return on their capital investments. But historically, that hasn't always been the case.
It's like if a company's costs are going up faster than they can raise prices, their profits might not be keeping up with inflation, even if their revenue is growing.
Right. And that's why Graham is so focused on looking beyond the surface. It's about understanding the underlying economics, not just getting swept up in general market trends.
So if stocks aren't a surefire solution, what other options does Graham explore?
Well, this is where things get interesting. He goes into this whole world of what he calls things, tangible assets like diamonds, rare books, even that 1804 silver dollar he keeps mentioning.
Okay, so maybe Graham was secretly a collector.
It's possible.
Yeah.
But he acknowledges that investing in these types of collectibles comes with its own set of risks. It can be very speculative, and the pricing can be subjective. And when it comes to something like real estate, which seems like a more traditional way to protect yourself from inflation, he does talk about it as a potential option.
Okay, yeah.
But
What about real estate? I feel like that's a common one people go to.
he does discuss it as a potential option. He highlights the benefits of owning a property and how it can potentially shield you from rising prices. But he points out some drawbacks too.
Oh, okay. Like what are some of the downsides he sees with real estate?
He's very realistic about it. He talks about how real estate values can fluctuate significantly, just like stocks. Location matters, of course. And there's always the risk of overpaying.
Yeah. And real estate isn't exactly known for being liquid or easy to diversify.
Exactly. So it seems there are pros and cons to every approach, just like with stocks.
So if there's no easy answer, what's Graham's ultimate advice when it comes to safeguarding your portfolio from inflation?
He emphasizes a familiar theme, balance. He doesn't advocate for putting all your eggs in one basket.
Right.
It's about understanding the complexities of each asset class, weighing the risks and rewards, and finding the right mix for your individual needs and
It's
circumstances.
about making informed decisions, not emotional ones.
Exactly. He doesn't want fear of inflation to drive investors into making impulsive or reckless moves. He emphasizes staying disciplined, staying informed, and sticking to a long-term plan.
That sounds like sound advice for navigating any market condition, not just inflationary periods.
Absolutely. And speaking of market conditions, there's another key aspect of Graham's philosophy that we need to explore, his perspective on the psychology of investing.
Okay, so let's dive into the mental game.
Yeah.
How does Graham view the emotional side of investing?
Welcome back to our deep dive into the intelligent investor. In the last part, we were exploring Graham's foundational principles.
Right.
And now we're tackling a topic that I know weighs heavily on a lot of people's minds these days.
Yeah, inflation.
Yeah.
How to deal with it.
It's been a constant headline, it feels like.
It has.
So many people are wondering, how do I protect my money, my hard-earned money, from being eaten away by rising prices?
Yeah. And Graham actually dedicated a whole chapter to this in his book, The Investor in Inflation.
Oh, wow.
What's really interesting is that, while he wrote this decades ago, his insights are they're so relevant today. They really are.
Yeah.
And he even talks about how the fear, or maybe for some people the hope, of a declining dollar, really heavily influences Wall Street thinking.
It's always there, right? Like this undercurrent
Yeah.
affecting everything.
Yeah.
And when it comes to inflation, Graham really challenges some common assumptions. Take common stocks, for example. Many people think that they are like a reliable shield against inflation. But Graham, he takes a more cautious stance.
It's interesting because you would think that as prices go up, companies raise prices, their revenues increase, and then logically their stock value should follow.
That's what you would think, right? But Graham reminds us that it's not always that simple. He argues that inflation can impact stock values in unexpected ways, and he actually dives into the historical data to back up his claim.
But he's not saying stocks are a bad investment during times of high inflation.
No, not at all. What he's saying is don't just assume stocks are a guaranteed inflation hedge. He points out that while stocks have done well over the long term, their returns haven't always kept pace with inflation. He analyzes this period of significant inflation from the 1940s to the late 1960s, and he finds that stock returns, while positive, weren't, as stellar as you might assume during that period.
So you might see, your portfolio increase in value, but your purchasing power could actually be going down.
Exactly. And he makes a really crucial point here that often gets overlooked. He says that for inflation to truly add to a company's value, it needs to boost the rate of return on their capital investments. But historically, that hasn't always been the case.
So it's like if a company's costs are going up faster than they can, raise prices, their profits might not be keeping up with inflation, even if the revenue is growing.
Right. And that's why Graham is so adamant about looking beyond the surface. It's about understanding the underlying economics, not just getting caught up in the general market trends.
So if stocks aren't a surefire solution, what other options does he explore?
Well, this is where it gets kind of interesting. He even delves into the world of what he calls things, tangible assets, like diamonds, rare books, even that 1804 silver dollar he mentions a few times.
Okay, so maybe Graham was secretly a collector on the side.
Maybe. But he does acknowledge that investing in these types of collectibles, it comes with its own set of risks. It can be very speculative, and the pricing can be really subjective.
And what about real estate? I mean, that seems like a more, traditional way to protect yourself from inflation.
He does talk about real estate as a potential option. He highlights the benefits of, direct ownership and how it can potentially shield you from those rising prices. But he also points out some drawbacks.
Oh, okay. Like what are the downsides he sees?
He's very, very realistic about it. He talks about how real estate values can fluctuate, sometimes significantly, just like stocks. Location, 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 right. And there's always the risk of overpaying.
And real estate's not exactly known for being, liquid
Yeah.
or very easy to diversify.
Exactly. So it seems there are, pros and cons to every approach, just like with stocks.
So if there's no easy answer, what's Graham's ultimate advice when it comes to protecting your portfolio from inflation?
Well, he comes back to a familiar theme, balance. He doesn't think you should put all your eggs in one basket.
Yeah.
It's about understanding, the complexities of each asset class and then weighing the risks and the rewards and ultimately finding the right mix for, your own individual needs and circumstances.
So it's about making informed decisions, not letting your emotions take over.
Exactly. He doesn't want fear of inflation to drive people into making, impulsive or reckless decisions. He emphasizes staying disciplined, staying informed, and sticking to a long-term plan.
That sounds like good advice for any market condition, really, not just inflation.
Absolutely. And speaking of market conditions, there's another key aspect of Graham's philosophy that we need to explore, his perspective on the psychology of investing.
Okay, so let's dive into the mental game. How does Graham view the emotional side of investing? Welcome back to the final part of our deep dive into the intelligent investor.
We've explored so much of Graham's wisdom already.
Well, yeah.
From defining what true investing is, how to deal with that tricky inflation.
Yeah.
And now we're stepping into an area that's often overlooked, I think, but is so important.
It is.
The psychology of investing.
Yeah, the mental game.
Because investing, let's face it, it's not just about numbers and spreadsheets and,
Right.
all that stuff. It's about, our emotions, our reactions. Sometimes we can be pretty irrational when it comes to money. Absolutely. And Graham really got this. He understood it. And he dedicates a lot of his book to exploring this psychological dimension of investing, especially in that chapter, The Investor and Market Fluctuations. Big one.
And he starts off by acknowledging something pretty fundamental about the stock market. Prices are going to fluctuate,
Always.
even for those blue chip, rock solid companies.
He actually uses the performance of the Dow Jones Industrial Average after he published his later edition of his book as a perfect example.
So he's talking about the market's behavior after he wrote the words.
Exactly. And what he saw was this pattern, the Dow going up and down, sometimes by hundreds of points over a period of, several years. And it wasn't just, small volatile companies. It was these large, well-established corporations
Yeah.
that we're seeing these big swings too.
It really drives home this point that market volatility, that's normal.
Yeah.
That's not the exception. That's how it works.
It is. It's like the weather. You can make educated guesses, but there are always going to be surprises.
And this is where Graham introduces one of his, I think, most brilliant concepts, this idea of Mr. Market.
Yeah.
Okay, I've heard this, this term thrown around. I got to be honest, I'm still a little fuzzy on, like, who is Mr. Market?
So think of Mr. Market as, this fictional character who represents the stock market. He's your business partner. And every day he shows up at your door offering to buy your shares or sell you his.
Yeah, so he's pretty persistent, this guy.
Oh, he's always there.
But I feel like there's a catch.
There is. The catch is that Mr. Market, he's emotionally unstable. One day he's euphoric, he's, irrationally exuberant, and he's offering you these sky-high prices for your stocks. Next day, gloomy, pessimistic, practically begging you to sell low.
So it sounds exhausting,
Yeah.
like an emotional roller coaster.
Totally. And Graham's point is that you, the intelligent investor, you have the power to choose how you react to Mr. Market's antics. You don't have to be swayed by his mood swings.
Yeah, you're not obligated to buy just because he's in a buying frenzy or sell just because he's, freaking out.
Right. You have the freedom to ignore his emotional noise and make decisions based on, a rational assessment of what your investments are actually worth.
So it's actually kind of empowering. It puts the investor back in control.
Yeah.
Rather than being at the mercy of the market.
Exactly. And Graham suggests that the intelligent investor, they should only really pay attention to Mr. Market when it serves them. When he's being super pessimistic, that's an opportunity, right? Scoop up some bargains. And when he's manic and everything's great, well, you can, capitalize on that irrational exuberance and sell at those inflated prices.
So instead of being something to, stress out about, Mr. Market can actually become a source of opportunity
Right.
if you play it right.
Absolutely. It's like take his weaknesses and make them your strengths.
Yep.
And this leads to one of Graham's most important pieces of advice. He says, the investor should learn to value his holdings and to ignore the temporary market fluctuations.
So it's about focusing on those fundamentals.
Yeah, on a company's intrinsic value, not getting caught up in the, day-to-day noise of the market.
Tuning out the chatter, sticking to the plan.
He even brings back that example of A&P, the supermarket chain we talked about earlier. Remember how its stock price went on a wild ride back in the 1930s?
Oh, yeah.
Driven by market sentiment rather than, how the company was actually
It
performing.
was a roller coaster, yeah. A prime example of how, price can be so disconnected from actual value.
And Graham uses that to, highlight the difference between those two things, the price and the value. A
Mhm.
company's stock price might be all over the place, but its underlying value, that's usually much more stable.
So as an investor, you got to be focused on that underlying value.
Right. And he makes this this bold statement. He says, the true investor scarcely ever is forced to sell his shares, and at all other times, he is free to disregard the current price quotation. So unless you absolutely have to sell, you can ignore those daily ups and downs and just hold.
That long-term perspective again.
And he goes even further. He actually argues that you can use market fluctuations to your advantage. When prices drop sharply, it's a chance to, to buy more of a good company, but at a discount. And when prices go through the roof, well, take some profits.
So volatility, instead of something to fear, becomes a tool for the intelligent investor.
Exactly. But to use that tool effectively, Graham says you have to have emotional discipline. Don't let fear and greed make your decisions for you. Don't get caught up in, what everyone else is doing.
Buying because everyone's buying. Selling out of panic.
Yeah, it's about making those rational decisions, not emotional ones.
So what's the ultimate takeaway here? What's the message that Graham wants us to remember about this whole psychology of investing?
I think it comes down to this. Be patient. Be disciplined. Focus on the long term. Don't let Mr. Market's mood swings, dictate your actions. Use your knowledge, use your research, use your judgment to make sound decisions.
Wise words from a legend. This deep dive into the intelligent investor, it's been incredible.
It has.
We've really explored Graham's core principles, from the importance of really separating investing from speculation to understanding that intrinsic value of a company to, keeping your cool when the market's going crazy.
Absolutely. And even though it was written decades ago, it's still it's just so relevant today.
It really is.
It's a testament to Graham's wisdom. He had this amazing ability to just cut through all that noise and give you this, this really clear, enduring framework for navigating this complex world of investing.
And I think it's a reminder that investing is a journey. It's not a sprint. It's about constantly learning and adapting and staying focused on your goals. So I really encourage you to pick up a copy of The Intelligent Investor and start your own journey to becoming a more informed and successful investor.
And remember, the best investment you can make is in yourself.
Mm.
Your own financial education. Keep learning, keep exploring, and most importantly, keep that long-term perspective.
Great advice. Hey, everyone, and welcome back for another deep dive. You know how we do it around here.
Yeah,
We take some really interesting source material, and then we really get into it.
we do.
And today we are talking about investing specifically through the lens of The Intelligent Investor.
A classic.
It is a classic.
Yeah.
It was written by Benjamin Graham,
Yes.
and this book is considered like the Bible of value investing,
Yes.
which is an investment philosophy that emphasizes finding stocks that are undervalued by the market.
Exactly.
So we're going to be taking excerpts from this book today and using them to kind of explore the world of Wall Street.
Yeah.
Particularly focusing on how to evaluate investments
Right.
and make smart decisions as an intelligent investor.
Yes. And I think it's so fascinating to kind of go back in time to the Wall Street of the 1970s when this book was really popular
Mm.
and see what's changed and what's stayed the same.
Yeah. I mean, imagine Wall Street before the internet.
I know.
Like no online trading platforms.
Yeah.
No instant access
Yes.
to information.
Yeah.
Like you would have to actually call your broker
Call your broker.
to place a trade.
Oh, yeah. Or go down to the trading floor.
My gosh, can you imagine?
Wild.
That is wild.
Yeah.
So let's dive into some of the key takeaways from the book. One thing that really struck me was the sheer volume of advice that was being thrown at investors. Even back then, it seems like everybody had an opinion on what stocks to buy or sell.
Yeah. It was almost like an avalanche of information. I mean, you think about it. You had brokerage houses, investment banks, financial advisors all vying for the investor's attention.
Yeah.
And a lot of it, wasn't necessarily helpful.
Oh, so it's not just a modern problem.
Right.
This has been happening forever.
It's always been a challenge for investors to sift through all that noise
Yeah.
and find the advice that's actually going to benefit them.
So how much of that advice do you think was actually geared towards helping investors make smart long-term decisions?
Well, that's a great question. And Graham actually argues in the book that a lot of the advice back then wasn't really focused on long-term value creation. It was more about, short-term speculation, timing the market, trying to make quick profits, which, as we know, can be incredibly risky.
So instead of getting solid guidance, investors were being encouraged to gamble.
In a way, yes. I mean, Graham makes a very clear distinction between what he calls speculation and investment.
Right.
Right? Speculation is you're betting on short-term price movements. You're trying to time the market.
Yeah.
You're really relying on predictions and a lot of luck.
Yeah.
But investing is about understanding the underlying value of a business
Okay.
and holding on to it for the long term.
So that long-term mindset is really
Right.
key.
Yeah.
Interesting. Okay, so let's talk about the people who are actually giving this advice. Who are these players on Wall Street that are shaping the conversation around investing? I'm picturing these smoke-filled rooms full of guys in pinstripe suits, yelling buy, sell into telephones.
It's a great image. It wasn't too far off. You had your customers' brokers, right? These are essentially salespeople.
Okay.
They execute your trades. They might offer you some advice, but their primary focus is really on generating commissions.
So not necessarily the most impartial source of advice.
Exactly right. Their incentives aren't necessarily aligned with yours as an investor.
Okay, got it.
And then you have your financial analysts. Now, these are the folks who are supposed to be the experts, right? They do the research, they analyze the companies, they make recommendations on what stocks to buy or sell.
Okay.
But here's where things get really interesting. Back in the 1970s, there were no formal requirements to be a financial analyst.
Wait, are you serious?
Yeah.
So anybody could just call themselves an expert?
Pretty much.
Wow.
It was the Wild West out there. I mean, unlike brokers who actually had to pass exams and be registered with the SEC analysts, could operate without any real credentials.
So how people put doctor in front of their name?
Right.
And then it's Dr. Divinity?
Exactly.
Like,
You could just say you were a financial analyst and people would believe you.
oh my gosh. That is wild. So
Yep.
how do you, as an investor, how do you know who to trust?
That's the million-dollar question, right?
Yeah.
I mean, Graham really stresses the importance of finding a truly qualified expert, someone who is actually focused on value, not just hype.
Okay, so we've got all these so-called experts running around. Some of them might not even be qualified.
Okay.
But let's say you found someone you trust. You're getting good advice.
Yeah.
What are some of the other pitfalls that investors need to watch out for?
Well, one thing that Graham talks about is the allure of new issues, particularly during a bull market.
Okay.
Right when the market's going up and everyone's feeling optimistic, it can be really tempting to jump on the bandwagon and invest in the latest hot IPO.
Yeah, everyone wants to get in on the ground floor.
Exactly.
Make a quick buck.
But the problem is that a lot of these new companies, they're unproven, they have inflated valuations, their fundamentals might be shaky,
Okay.
and investors can get swept up in the hype and end up losing a lot of money.
So it's like the fear of missing out, FOMO,
It is.
can really cloud your judgment.
Absolutely.
Yeah.
And Graham actually compares the flood of new companies that went public in the 1960s to an unprecedented outpouring of issues of lowest quality.
Wow.
I mean, he was seeing a lot of companies come to market that really shouldn't have been there.
So how can investors avoid falling for that trap? How can they tell if a new offering is actually worth considering?
Well, one key is to look beyond the hype and focus on the fundamentals, right? What is the company's business model? Do they have a competitive advantage? What is their track record of profitability?
So don't just blindly follow the crowd. Do your own research. Make sure the company's actually worth investing in.
Exactly. And don't forget about the role that investment banking firms play in this process, right? They advise companies on going public. They underwrite the offerings. And that can create a conflict of interest.
Ah, so they're kind of like a used car salesman who's also the mechanic. They have a vested interest in convincing you to buy, even if the car's a lemon.
That's a great analogy. As an intelligent investor, you need to be aware of those potential conflicts and approach new offerings with a healthy dose of skepticism.
So we've talked about avoiding getting caught up in the hype of new offerings. But what about the excitement around a company's reported earnings? How should investors be looking at those numbers?
That's such a crucial question. And the intelligent investor really goes deep into the importance of understanding and analyzing earnings. And one of the key takeaways here is that you can't just focus on a single year's earnings,
Okay.
because companies can manipulate their earnings to make themselves look better than they actually are.
You mean like by using like creative accounting tactics?
Exactly. They might try to charm away losses by burying them in the footnotes or by using special charges and credits to inflate their earnings per share.
So they're basically putting on makeup
Yeah,
for their financial statements to
Yeah.
try to make themselves look prettier
they're trying to present the best possible picture.
than they actually are.
To invest.
So how can investors see past that makeup?
Hmm.
How can they tell what the real earnings picture is?
Well, one way is to understand how these manipulations can happen, right? To learn to look beyond the headlines and dig deeper into the footnotes and the financial statements.
Okay, so you're saying you had to be a little bit of a detective
Yeah.
when you're looking at these financial statements.
You have to be skeptical.
Yeah.
You have to look for inconsistencies,
Hmm.
red flags,
Yeah.
things that don't quite add up.
Right.
And remember, investing is about long-term value, not short-term fluctuations.
Right.
So don't get too caught up in the hype of a single earnings report. Look for consistent performance over time.
Got it. So this all sounds really important. I mean, this is great advice, but it can also feel a little bit overwhelming,
Right.
right? You know, like we're talking about analyzing earnings. We're talking about understanding financial statements. You know, it's like, how can the average investor really make sense of all this information
Yeah.
and protect themselves from making costly mistakes?
That's where the concept of margin of safety comes in.
Okay, I like that. Let's dive into that. What exactly is the margin of safety and how does it protect investors?
Well, think of it like this. Imagine an engineer designing a bridge. They don't just build it to handle the expected weight. They build in an extra margin of safety to withstand any unexpected stresses and strains.
So they're basically being extra cautious.
Exactly. Just in case something unexpected happens.
Yeah.
And it's the same principle with investing. You don't just buy a stock based on its current price or even its projected earnings. You look for a cushion, a margin of safety, between the price you pay and the intrinsic value of the company.
So you're saying like you're looking for stocks that are essentially on sale,
Precisely. You want to buy $1 for 50 cents.
where the price is lower than what the company is actually worth.
Exactly. And this is especially crucial when it comes to those growth stocks.
Okay.
Those companies with high expectations for future growth, investors often get so caught up in the excitement of the potential
Right.
that they overpay. And that leaves them vulnerable if that growth doesn't materialize.
It's like buying a house based on the beautiful landscaping
Right.
and ignoring the foundation problem.
Exactly. You might be in for a rude awakening later on.
Right. So how do you actually determine that margin of safety?
Well, it starts with understanding a company's earnings.
Yeah.
And as we were just discussing, you can't just look at a single year's earnings.
Yeah.
You have to dig deeper. You have to look beyond the headlines.
And you mentioned like scrutinizing those financial statements.
Exactly.
Is there anything specific that investors should be looking for?
Well, one thing to watch out for is the use of special charges and credits.
Oh.
These are often one-time expenses or gains. That can really distort the true earnings picture.
Can you give me an example?
Sure. Let's say a company reports a big drop in earnings one year due to a restructuring charge.
Okay.
Now, that might sound alarming, but if you look closer, you might find that the restructuring is actually a positive step. That will make the company more efficient in the long run.
So a short-term hit to earnings
Right.
could actually be a sign of long-term strength.
Exactly. And Graham also cautions against relying too heavily on a metric called primary earnings per share.
What is that exactly?
It's basically a way for companies to present their earnings in a more favorable light by excluding certain costs or charges.
So it's kind of like airbrushing your earnings?
It can be.
Yeah.
If you don't understand what's being excluded,
Okay.
it can be very misleading.
So it's important to like look at the full picture,
The whole picture.
not just the highlight reel.
Exactly. Don't be fooled by the fancy packaging.
Right. So as intelligent investors, we need to be wary of these accounting tricks and focus on the true underlying earnings power of a company.
Precisely. And once you have a good understanding of the earnings, you can start to think about the company's growth potential, right? How fast has the company been growing? Is that growth sustainable? What are the factors that could drive future growth?
So you're looking for companies that are not only profitable,
Right.
but also have a runway
Yes.
for continued growth.
Exactly. And remember, growth doesn't happen overnight. It's a long-term process. That's why it's so important to have that long-term investment horizon
Yeah.
and avoid getting caught up in those short-term market fluctuations.
So we've talked about analyzing earnings. We've talked about understanding growth potential. What are some other factors that investors should consider when they're evaluating a company?
Well, one important factor is management quality. Are the leaders of the company competent? Are they ethical? Do they have a track record of creating shareholder value?
So you're not just investing in the numbers.
Right.
You're investing in the people
You're investing in the people who are running the show.
that are running the show.
Exactly. And you also want to look at the company's financial strength. Do they have a lot of debt? How much cash do they have on hand? Are they generating consistent cash flow?
These all sound like important indicators of a company's ability to, weather those economic storms.
Absolutely. And finally, you want to consider the company's competitive landscape. Do they have a strong moat around their business? Are they facing any major threats from competitors?
So even if a company's doing well today, you need to think about whether they'll be able to maintain that success.
In the future.
Yeah, in the future.
Exactly. All of these factors, the earnings, growth management, financial strength, competitive position, they all contribute to a company's intrinsic value.
Okay.
And remember, as intelligent investors, we're always looking for that margin of safety. We want to buy companies for less than they're actually worth.
That makes a lot of sense. But how do you put all these pieces together? How do you go from analyzing individual companies to building a well-rounded investment portfolio?
That's a great question. And the intelligent investor actually provides some guidance on that. It distinguishes between two types of investors,
Okay.
the defensive investor and the enterprising investor.
Okay. I'm intrigued. Tell me more about these two types of investors.
So the defensive investor is primarily focused on minimizing risk and preserving capital. They're not looking to get rich quick, but rather to build wealth steadily over time.
Okay. A slow and steady wins the race kind of approach.
Yeah, you could say that, think of it like the tortoise and the hare fable.
Got it. So what about the enterprising investor? Are they more like the hare hoping to, win with a quick burst of speed?
Yeah, they're definitely more willing to take on risk in pursuit of those higher returns.
Okay.
They might invest in things like smaller companies or emerging markets or what are called special situations, where there's a specific catalyst that could unlock value.
So a bit more adventurous.
Yeah, a bit more hands-on for sure.
It sounds like the key difference here is really their risk tolerance
Right.
and their investment goals.
Absolutely.
So what kind of portfolio recommendations does the book give for each type of investor?
Well, for the defensive investor, Graham suggests a portfolio that's primarily composed of high-quality bonds and a diversified selection of large, stable companies.
So a solid foundation
Yeah,
built on stability and security.
exactly.
What about for the enterprising investor?
Well, for them, the book recommends a more flexible approach, allowing for a wider range of investments,
Yeah,
including those smaller companies and potentially more volatile assets.
thought idea.
But even for the enterprising investor, diversification is still key.
That makes sense. Don't put all your eggs in one basket, as the saying goes.
Exactly.
So regardless of whether you're a defensive investor or an enterprising investor, it sounds like the intelligent investor really emphasizes the importance of thinking independently
Yes,
and not being swayed by the Wall Street hype machine.
absolutely. It's about doing your own research, understanding the fundamentals of investing, and making decisions that are right for you.
Based on your individual goals and risk tolerance,
Exactly.
it sounds like it takes a lot of discipline and patience to be a successful investor.
It does, but it can be incredibly rewarding.
And that brings us to another really crucial aspect of investing that the book explores: the psychology of investing.
Oh, yeah.
It's not just about the numbers, it's also about managing your own behavior
Absolutely.
and avoiding common psychological traps.
Our emotions can often lead us to make irrational decisions.
So how do we avoid letting our emotions get the best of us?
Well, Graham introduces this really interesting character in the book called Mr. Market.
Mr. Market.
Yeah, who is Mr. Market? He represents the overall mood of the market, which, as we know, can swing wildly between euphoria and despair.
Okay.
Sometimes he's offering you great prices, and sometimes he's trying to sell you overpriced assets.
So he's kind of like that unpredictable friend
Yeah,
who can be really fun to hang out with sometimes, but can also drag you into some bad decisions.
exactly. And the key as intelligent investors is to not let Mr. Market dictate our actions.
So how do we do that? How do we stay rational when everyone else seems to be, losing their minds?
Well, it starts with having a well-defined investment strategy and sticking to it. Don't let short-term market movements derail your long-term plan.
So don't panic and sell everything when the market takes a dip.
Exactly. Remember, you're investing in businesses, not ticker symbols.
That's a really good point. It's easy to get caught up in the day-to-day fluctuations of the market and lose sight of the bigger picture.
Right. It's like trying to drive a car by looking only at the rearview mirror. You're going to end up crashing.
That's a good analogy. So stay focused on the road ahead.
Exactly. And it's also important to understand your own risk tolerance.
Okay.
Don't invest in something that's going to keep you up at night worrying. Choose investments that align with your comfort level and your financial goals.
So know yourself and invest accordingly.
Precisely. And finally, remember that investing is a long game.
Okay.
Don't expect to get rich quick. Be patient, stay disciplined, and let the power of compounding work its magic over time.
This has been an incredible deep dive into the intelligent investor. It's amazing how relevant this book remains, even though it was written decades ago.
It really is a testament to the timeless principles of value investing.
So to all our listeners out there, remember to think independently, do your research, and always seek that margin of safety. And most importantly, don't let Mr. Market lead you astray.
Words to live by.
Thanks for joining us on this deep dive, and we'll see you next time.